think I'm recording. Hey everybody, how's it going? We're gonna do chapter 11, investment plan. This is kind of good stuff. It's kind of meaty stuff. I realize when I do my hands with this, hand gestures just look fine to me, but since I'm so close to the camera, it's kind of, kind of creepy. Anyway, we're gonna do chapter 11, investment planning. And for whatever, in my mind, I always thought there were 16 chapters in this book, but there's only 15. So we're just getting into the home stretch here. So we'll do chapter 15. I'll get those, and I'll do chapter 11 right now. And then I'll kind of just hit you real hard after that with the rest of them. And then we'll, you get some quizzes in there and a final, and then we will be done. D-U-N-N, done. And please don't correct me about how spelling done. I know how to spell it. Okay, let me share my screen here for a second. View, what is this show? Slideshow. Oh shoot, that's not the right way to do that. Hold on. I always think I'm going to be a little smoother with this, and I somehow butcher everything. It's destroyed my life. All right, let's do this. View. Slideshow right there. Awesome. Class. Can I do that? Perfect. Investment planning. Let's get into it. What is investing? Investing basically, some of these slides are going to be very, very, very kind of just, self-explanatory. It's just the process of placing money in a medium, such as stocks or bonds, in the expectation of receiving a future benefit. Just, you want to put $1 and invest $1 into something, and hopefully you'll get more than $1 at some point. If you get, $1.10, that's good. Expected rate of we'll get into the IRRs, which is a kind of a term that you should be familiar with, that if you hear that a lot, when it comes up in life. But generally, for the most part, with stocks, you should be getting, 8 to 10%, which is good. So about 9%. Bonds, 3.5%, 4% is fine or acceptable. And we'll get into the difference between those two. And also we'll get into putting a portfolio together, diversification, reallocation, and then how you balance that portfolio a little bit later. Some kind of high level stuff, but I just want you guys to kind of know what some of these things are. Speculating. That's kind of just your way of investing, or almost in a sense gambling too. Speculating is basically a form of investing in which the future value and expected returns are highly uncertain. You could have somebody say, expect to make, a certain amount of money. And that's a big indication there, is that if you get involved with somebody and they are guaranteeing, you're telling you this stock, this investment is going to make you, if they're saying anything over 10%, be very, very skeptical. Really good, really reputable people won't even give you an amount. They'll say, they'll know it's kind of more of a long play. We'll get into that kind of strategies a little bit later too, but it's all speculation. There's no guarantees, but there are just patterns that happen in investing that just kind of lead to certain expectations. So how to get started? There's so many it's so much easier to get started now, investing if you want than before. So to come up with some capital. Capital is just a fancy word for money, right? So come up with some capital. Have an investment plan that provides direction. Don't just kind of aimlessly, you can, but you got to have more of a direction and more of a strategy. So come up with some capital, some money. Have an investment plan that provides protection, and you got to figure out, hey, where do you want to go with the investment? What's the goal here? It's kind of like we talked about before about, hey, a goal without a plan is just a wish. What's the plan? What's the plan? Where do you want to go? What do you want to do with your investments? So what are your investment objectives? Kind of dovetailing into that. Do you want to have these investments so, in the future you can, or even currently, that you can make income off this? You can basically live off your income from your investments. Are you saving money and trying to invest money and trying to make money on your investments for a major expenditure, like a down payment for college, for capital or money for a business, for a vacation, some type of expensive item, or for retirement. That's a huge one. The next one is retirement. Are you use your investments as kind of a shelter from tax write-offs? So knowing that, okay, I'm going to have a certain amount in write-offs, on the other side, I'm going to have makes a certain amount in your investments. Those are all kind of strategies to have when you or the objectives with investing. Different ways to invest. There's common stock, which is just basically buying stock of the company. So when you buy stock of a company, if you want to get stock in Apple or Crystal Guy, the company makes Crystal Geyser, or some other companies, you can you're basically buying a small percentage, a small ownership of a company, a very small. So you basically own stock, a percentage of ownership in that company. That's what buying stock is. When you get bonds, basically you're lending money. You're giving money and lending money to a company or a municipality, meaning it's either a legit company. So a company, sometimes if they want to do some expansion, they want to kind of increase investment into their company, or they want to do something, but they want to spend their own money, they will basically say, we're going to do bonds, meaning you lend that company money, but then on the back end of it, you will get paid. If you give them $1, you will get $1.03, $1.04 somewhere down the road. It's not going to be $1. It's going to be more than that. So basically, you are lending money to a company or municipality. What is municipality? That could be a state, like a state of California municipal bonds. That can be a county bonds. Those can be a specific state bonds. So if a state wants to raise money, then they don't want to raise taxes, they can say, we are selling bonds for this to improve the roads, to improve the electricity, to improve the water, systems, or many other different areas, any kind of the infrastructure within or like a high-speed rail. So those are good things, transportation. And they say, we don't want to raise taxes, which is one way for us to have this money, get this money as capital for this project or this expenditure. What we're going to do is we're going to sell bonds. So basically, anybody can go out and basically lend us money, but they are going to get back more money than they gave us. So bonds are basically you're lending money to a company or municipality. Preferred stock, that's basically stock where there's an attached dividend or return guaranteed. So you have your stock, and then you basically have a guarantee that I'm going to put this much money into a company, and there's a guarantee, somewhat of a guarantee, or a guarantee of I'm going to get a certain amount back in a certain period. Then there's mutual funds. So basically, mutual funds is you're part owner of a portfolio. So when you buy a mutual fund, what you're really doing is buying a collection of stocks. So let's think about this. Let's think about you have when you buy one stock, you have that stock in that one company. When you buy a mutual fund, you're basically buying a bucket of different stocks that for the most part are selected by that mutual fund company. There are, if you want to have certain or specific areas or industries that you're interested in, you can do that. But basically, you're buying a little piece of a bunch of companies for a mutual fund. That's a specific product. And then there's also ways to invest in real estate: raw land, commercial property, residential property. Raw land would just be a plot of land, piece of dirt, a field, someplace that land that's not developed. Commercial property, that can be something in a retail establishment, something industrial, a place basically of commerce where money is made off of that real estate, or residential, which can be a single home, apartments, condos, all those kind of places. Securities markets. This is a marketplace in which stocks, bonds, and other financial instruments are traded. There's places that you can go. Not really so much physically, but there are physical options, and you can trade and purchase stocks. When I say trade, it means sometimes you buy, sometimes you sell. And there's primary and secondary. The primary markets are going to be, the big ones like the NYSE, New York Stock Exchange, NASDAQ, those kind of places. Secondary are kind of like companies that are a little bit smaller, but they're not quite at the level to be on the publicly traded at the level of the New York Stock Exchange and NASDAQ. What's a prospectus? Prospectus is basically a document made available for prospective security buyers or prospective people who want to buy stock in a company that describes the firm and a new security issue. This means security. It does not mean like, security that wants to keep you out, wants to kick you out of the grocery store, kick you out of a parking lot. Security is an investment opportunity. So a document made available to prospective buyers of a stock that describes the firm and new opportunities to invest. That's a better way to say it, instead of a new security issue. New security issue makes it sound like, okay, there's some homeless guy hanging outside of our house, or there's some drunk on the corner. No, it's a new investment opportunity. Okay. Securities and Exchange Commission. That's a big one. The SEC, also known as the SEC. It's an agency of the federal government that basically regulates the disclosure of information about securities and generally oversees the operation of securities exchanges and markets. This is the regulatory agency that monitors the stock market. In a sense, they're the big boys. You don't want to have SEC violations. That's a big problem if you do within your company. So if you ever hear somebody saying, "Oh, I got in trouble with the SEC," this is the Securities and Exchange Commission. It's kind of like the Securities and Exchange Commission is kind of like like if you're driving your car on the freeway, you're going to get in trouble from the CHP, the California Highway Patrol. If there are certain, there's the FBI, Federal Bureau of Investigations, that basically investigates anything on a large scale federal sense, criminal enterprises. The Securities and Exchange Commission, the SEC, is specifically there to regulate and investigate financial institutions and securities and stocks being traded. And they have to do a lot. I mean, there's a lot to investigate. There's a lot of shady people in that world. And by the way, I mean, there's a lot of really, really smart people in the stock industry and the financial industry, because, for the most part, they look for people, who went to, not always, but if you wonder why, it's okay, why these big companies, these Goldman Sachs and these Morgan Stanleys, always looking for these people who went, to Harvard and Princeton and Stanford and Yale and, all these, highly rated universities, and have these really high, SAT scores and for graduate school, potentially like a GMAT score or GRE scores. They look for people who have we'll say a very impressive and very large mental bandwidth. I'll just say it that way. Meaning these are people who can go into a situation and with the given circumstances in the financial world, can look for, it's called the arbitrage, which is that kind of that gray area, or that area that's a little bit questionable, to potentially read between the lines to make money for companies with the given laws. So, and for the most part, not always right, these are people who were achievers at one point, did well on like standardized tests. So they look for people with like large mental bandwidth that can find the arbitrage in the financial industries. Bull market. Bull market, do you think that's good or bad? Good. That's what you want. You want a bull market. It's a market condition normally associated with optimism, economic recovery, and expansion, characterized generally by rising security or rising stock and bond prices. So bull is good. Bear is bad. I wonder who would win in a fight between a bull and a bear. It's a tough question. I don't know. These are the questions that keep you up at night, right? It's a condition of the market typically associated with investor pessimism and economic slowdown, characterized by generally falling security prices or falling stock and bond type prices. Who's a stockbroker? It's a person who buys and sells securities on behalf of clients and gives them investment advice and information. You usually have to, to get stockbroker's license, or certain certification that you need, like a Series 6, Series 7, Series 6 and 63, Series 7 type of licensing that you get, that you study for. It's kind of like kind of standardized test, and then you can have the ability to buy and sell products and securities on behalf of your clients. What's a full service broker? It's basically a broker who, in addition to executing the client's transactions, they offer a full array of brokerage services. So there's more than just the regular traditional buys and sells. There's a little bit more meat on that bone. We won't get too deep into that at all. Discount broker, not really that important. It's basically a broker with low overhead who charges low commissions and offers few or no services. So it's like you're basically just strictly a broker. They're not going to add too many services on top of that. And what kind of services? Remember we were talking earlier about some of the checking accounts that you can get, and there are some services that you can get attached to your like money market accounts, and where you can have your account set up in a way where your money gets swept at the end of every month, meaning all of you have an account, and then you have all of your bills taken out, everything, the big ones taken out, and then the money from your investment is put back into that account every month. The discount places, they really don't have any things like that. Just no frills, strictly trading securities and lower commissions. But sometimes that's all people want. What's an online broker? Basically, discount broker through which investors can execute trades electronically and online through a commercial service or the internet, also known as the electronic broker or internet broker or electronic broker. More and more common now. And I forgot to say, it's like, there's some easy ways to get involved now. Like there's Robinhood's a good one. Great or Grand Banyan is a good one to get going with stocks. I highly recommend doing these. They're really easy. It's very, very, very low barriers to entry to get started with some of these companies and to start investing. And I'll get into like what kind of stocks you should select too a little later. Securities Investor Protection Corporation, SIPC. It's a nonprofit corporation created by Congress and subject to the rules of the SEC, the Securities and Exchange Commission, and congressional oversight that ensures customer accounts against the financial failure of a brokerage firm. Basically guaranteed the money that you have invested would be kind of like the FDIC, how we had for your money being protected and guaranteed if it's in a bank. Similar to that, but this is with securities. If you have your money invested in a financial or with traders, financial institutions. I'm going to go through these. These are really not that important. Market order. This is kind of getting more in the weeds here. There's an order to buy or sell a security at the best price available. The time is placed. I won't worry too much about it. Limit order. In order to either buy a security at a specified or lower price, or to sell a security at or above a specified price. Stop loss or stop order. In order to sell a stock when the market price reaches or drops below a specified level. So you can basically have your stock set up. It's like, okay, when a stock hits a certain level, a low level, you can decide, okay, I'm going to either buy that stock or I'm going to sell that stock. The same thing on the upper level. You can basically just kind of have these already like kind of pre-triggered in your account so that you think, and why would you want to do that? Let's say you have a stock and you think, okay, there's no way it's going to go over $30 a share. I'm just going to arbitrarily throw the number out there. And then once it gets to 30, because you think that's the peak, it's not going to get any higher. They say buy low, sell high. So when it gets at the high, you sell all that off, and then you invest that into something else. Maybe not to sell all that off. You still might have confidence in it. Sell a decent percentage of the stock you have in that company. So it's all the kind of this kind of game that you have. Rate of return, or IRR, like anticipated or expected, or ERR, actually the rate of return. And IRR is the intended rate of return. So it's basically just on a stock, this is the change in price plus any dividends received over the investment period, both dividend by the original price paid for the stock. That's just a really complicated way of saying how much money are you going to make? What are you expecting to make on this stock? Was the rate of return, okay? Or the IRR, the intended rate of return. Annual shareholders reports. These are available for anybody. It's a report made available to stockholders and other interested parties that include a variety of financial and descriptive information about a firm's operation in the recent past. You can go and maybe we'll do that in a second here. Let's do that right now. No, I'll do that in a different video. You can go and just find these annual shareholder reports, and you can get financials and get access to, if it's a publicly traded company, like it's the companies, their stocks being traded, you can find their shareholder. They have a legal obligation to make these reports and information public, and they're in theory not supposed to do anything, crooked, but they have to put these shareholder reports out there because the shareholders are basically the owners of the company in a sense. They own a percentage of the company, so they need to know what is going on with that company. The Dow Jones Industrial Average, that's just based on it's the most widely followed measure of stock market performance, consists of 30 blue chip stocks, we'll get into that, listed mostly on the New York Stock Exchange. And that's just a good indication of how the stock market is doing, is to the Dow Jones Industrial Average. And those different companies are across like different type of field. S&P indexes, the Standard & Poor's index is just an index compiled by the Standard & Poor's. An index, how's the best way to describe an index? An index is just kind of a measure of performance for a thing. It would be kind of like for gasoline, there'd be, or petroleum prices, there's kind of an index of how things are performing. Like the price of oil kind of goes up, goes down, goes up, down. That's kind of like in a sense what an index is. But the Standard & Poor's index is compiled by the Standard & Poor's that are similar to the Dow Jones Industrial Average, but they basically employ different computational methods and consist of far more stocks. There's many more stocks on the Standard & Poor's than in the Dow Jones. The New York Stock Exchange index, an index or kind of just a sampling of the performance of all the stocks listed on the New York Stock Exchange. So actually, I want to be a sampling. That's kind of be more of in the aggregate. Here we go. Starting investing. Set aside money to get started. It can be a little $50. It's super easy to get started now. Learn investing jargon. I don't know if this website, I was just looked it up. I was going to share it with you, called investorwords.com. And you can kind of know the words, know the jargon of investing. Practice with a paper count before investing with real money, so you can kind of just track things, before getting involved with paper count or a spreadsheet. So you can kind of think, I'm going to invest X amount of dollars in this, X amount of dollars in that, this. Maybe create a spreadsheet or kind of start on paper and see over a few months what that looks like, how that would perform. It's a fun thing to do. And just gradually just keep adding a little bit more money into it. And monitor your portfolio's performance is a big one. And then keep up with the financial news. There's a bunch of places to keep up with the financial news. That's on page 299-ish in there. I'm going to expose you to a couple things as well. Let me get to get through the slideshow. Portfolio. Yeah, we're getting a portfolio. I'm going to do that, definitely. It's basically a collection of securities. Let me see how many slides I have left. Okay, portfolio, diversification, asset allocation. Okay, let me write this down. Actually, I'll do it here. Portfolio. Keep this. Portfolio is just basically a collection of securities assembled for the purpose of meeting common investment goals. Let me get my pencil here. Sorry. I'm just going to scribble this on. I'm really a teacher. Look at 3 red pens. What's wrong with me? Why do instructors always have red pens? Actually, I hate red pens. I actually use green pens instead because red's kind of harsh. But to get a green, you got to get a red. You usually can't buy a green by itself. They come in packs. So let's do something. Sign portfolio, diversification, and asset allocation. Perfect. I'll open up a Word doc here in a second. We'll kind of go through this. So portfolios is basically a collection of securities or stocks assembled for the purpose of meeting common investment goals. Portfolio, everybody knows a portfolio sounds like, a bunch of pictures put together, but it's just a collection of your stocks. I'll get you into I'll give you some good examples of portfolios and what it really looks like and how you can diversify. See how I did that? What kind of diversification that you can get. The process of basically choosing securities or stocks with dissimilar risk return characteristics in order to create a portfolio that provides an acceptable level of return and an acceptable exposure to risk. Why do you want to diversify? You want to diversify because you don't want to have all your eggs in one basket. I was in sales and I would sell stuff to hospitals. I had a friend who worked for Xerox, and we kind of had this similar attitude of, we would never want to have more than 5% of our business invested into one company. Because what happens if let's say you get a big customer and they're like 50% of your business or 75% of your business, and then they end up going with somebody else. And like you're like, in a sense, let's say you're selling bananas, okay? And you have a banana farm. I don't even know if there are banana farms. You're selling bananas and you only sell your bananas to Trader Joe's, right? That's great. Awesome. You're living a high in the hog. You can buy them there for 19 cents or 29 cents. Who knows how much you're supplying them for? And you're doing great. Then all of a sudden, Trader Joe's finds somebody else who they can buy their bananas from. And they say, see ya, bye, you're done. You have to find new people to sell your bananas to, right? That's why you have a situation, you sell a little bit to Trader Joe's, a little bit to, what's the other place? Sprouts, sell a little bit to Ralph's, sell a little bit to all these different places. So if you lose one piece of business, it's not going to kill you. That's the same thing with diversification. If you have only like one stock, if that stock goes in the dumper and tanks, then you're kind of screwed. That's why you want to have many different stocks and to kind of spread out that risk. It's like that if you're investing in real estate, maybe you shouldn't have all of your money invested in single family homes in Southern California. Find emerging markets. Find, the Boulder, Colorados, or the or Tennessee. I have a friend just got back from Tennessee who's invested in a place. In Arizona, in where is it? North Carolina. There's a big emerging market in North Carolina as well. Charlotte, North Carolina. Invest in these places so you can have your risks spread out, so you don't have that situation where you lose everything at once. And then asset allocation. It's basically a plan for dividing a portfolio among different classes of securities in order to preserve capital. And we will get into that actually right now. Let's do that. So I'm going to stop share momentarily. Close this bad boy out. We're going to get a blank Word doc. Kind of roll through this here. All right, screen share. Perfect, good, let's do this. It's a little bit bigger. Okay, so let's get into portfolios. What is a portfolio? It's a collection of stocks. Best way to describe this, I always like to do this. Let's think about candy. Who doesn't like candy? If you don't like candy, get off this right now. Let's say you have different, I like to say, let's say there's chocolates, right? I love, who doesn't like chocolate? Oh my God. Chocolate's the best, right? Then you get your gummies. Oh, love the gummies. Then you got like a hard candy, right? Got a hard candy. And then you can do high end. We'll do high end chocolate, right? High end candy. Okay. So you got your portfolio. Say you have your portfolio of chocolates here, right? What do you got in chocolates? You got bars. You've got like M&Ms kind of thing, right? What else do you have in chocolates? You got like chocolate covered things like raisins and that kind of stuff. I don't know how to spell it. Or like chocolate covered fruits, say that. You got bars, you got M&Ms, you probably saying something right now, but I can't hear you. So okay, that's it. It's something that probably will come to me later. You got gummies. Yeah, what do you got? Bears. You got worms. You got your sours. You got what else? You got like I like those Swedish fish. I've always had those in our office, those kind of things. Ropes. Who doesn't like a good gummy rope or something? Okay. Now you got your hard candies. You got like mints. You got like Jolly Ranchers, right? You got like Lifesavers. You got Jawbreakers. I'm kind of really old with my candy. I'm gonna put like, and you get high end, which is like C's, like Godiva, like I like those Lindt. Those are really good. Thing. Not too high end, but good enough. Not too bougie, right? So if you had a portfolio of candy, I got really close to the camera or the screen there. It would look like this. It's kind of cool. You get your chocolates. Within chocolates, you have different kinds of things. Also, let's do. We'll do like pieces, there are many, and so there's a lot of different ways, a lot of different candies that you can get. Okay, so that's how it would be if you had candies, right? So now let's go like this. And if you're gonna do within the bars, you're gonna have like a Snickers. Maybe a Milky Way. Milky Way much better than Snickers too. I don't even want to hear it. I don't want to even hear that argument. You got like a Twix, even though there's two pieces. You got a Reese's peanut butter cup. Oh boy, those are good, huh? They're in the bar family. I mean, don't tell me like that's not a bar because there's two individual pieces. Just cut me some slack here. So these are different types of candies that you can have. Okay, now how does this attach or connect with stocks? Okay, let's say instead of it being chocolates, you're going to go energy companies, right? What would that look like? Right, that would be like oil, could be renewable energy, right? That could be what else do we have? Like natural gas, right? What else do we have? And so instead of gummies, and then within the oil, there are many different companies to invest in oil. Within renewable, there's a lot of different companies to invest in renewable energies. Within natural gas, there's a ton of different companies. There's like batteries. Like that's a big thing. Like the like long-term batteries. Instead of gummies, you've got tech, right? What do you have in tech? You have hardware. You got software. What else would you have in tech? You would have just straight up data companies. You would have kind of storage type companies, tech storage companies. Okay, get it? Let's say then you have health, and then within the tech, there's a ton of hardware companies, a ton of software companies, ton of data companies, right? And then let's say you have health or healthcare, right? Within healthcare, instead of gummies, you have insurance companies, and there's a lot of insurance companies, right, that you can invest in. There is medical device companies, right? There are insurance companies, medical device companies. There's like medical billing. There's like suppliers, like distributors, right? There's pharmaceuticals. So that's all these different companies that within this one category that you can invest in. And like I said, there's a lot of different device medical device companies, a lot of different companies, distributors like Cardinal Health and McKesson, these kind of companies. And then you have like in high end, let's do, what else? Let's do transportation, right? There can be auto companies, a ton of auto companies. There are airline companies, a ton of airline companies. You can even put like a, yeah, I guess you can maybe say like a FedEx or UPS, like a courier, you know, courier type company. So this is basically a portfolio. We started with candy, but now you have a portfolio or just a wide range of those companies. So, and then also, what is this? This kind of dovetails into the diversification. See how we talk about diversification? This is a highly diversified. That's probably beautiful. Are horrible for you guys to watch me type. Diverse. Good. I'm always thrilled when I don't see the red lines under it. And by the way, it's much more stressful to type and write things when you know everybody's sitting in the back and judging. And then it gets into asset allocation, right? How are you going to allocate all of these? These are just different categories. So basically, diversified means you have different categories. Asset allocation, what we're getting to there is, in that, let's see here. Let's say that. Oh, shoot. Let's do that. So in your asset allocation, what are you going to do? You're going to stocks. Let's say stocks. Bonds. Binds. Let's just put some real estate here, John. So within your stocks, you're going to have a collection of these kind of things. Within your bonds, you could have a collection of these type of companies or these type of opportunities. And then within real estate's a little bit different. You have your residential, your commercial, hospitality possibly. So within here, you're going to have. I'll get into I think the next video is going to be more about how you balance that and how you balance that over time. A little sneak peek to that would be, let's say, stocks are going to be the traditionally what's going to make you potentially the most money. It's going to yield you the most, usually about like I said, 8, 9, 10% a year. Bonds are going to be 3.5%, 4, 5% a year. So stocks are riskier. So and then real estate is fairly consistent. So let's say this is kind of a little sneak peek. Let's say when you're in your 30s, you're going to go 70% stocks, 20% bonds, 10% real estate, right? Got that? And then let's say when you get into this, let's see if I can do this. No, butchering this too bad. It's in your 30s. You can do that, right? Say you get in your 40s, and then we're going to go, what's this, still 30s, sorry, I did a really bad job at this. And go here, right? I think this is too close, there you go. So in your 30s, you're going to have an allocation of stocks, your bonds, your real estate. This is basically called balancing. We'll get into that a little bit more, just to kind of sneak peek. Then let's say you got you in your 40s, you're going to do, you know what? I'm just going to, because stocks are going to be potentially it's going to make your money grow the most because you get more of a return on it, right? And then you're going to say, I'm going to go, instead of 20%, I'm going to go 30%. Let's just say we're going to 25%, a little bit more. And then you're going to go, and then real estate, you can go up to about 15%. So you're basically putting a little bit more money in two different areas and less money in stocks. And then that could change over your lifetime where it gets to the point where you have less money in stocks sometimes even no money in stocks, but more money in bonds. And why do you want to do that? Because stocks is this is gonna potentially it's gonna make you money, right? The bonds is what's gonna keep the money. Okay. So these are your growth opportunities, and this is kind of your stabilizing opportunities. And real estate's kind of a mix of both. So, all right, it's kind of cool, huh? All right, let me go through. Find some. Here, I can hear the bells going on outside here. And then we're gonna go. You may hear 8 bells go off here in the background if you can really pay attention to it. Okay. Let me see if this one works. That slide does not work. Oh, I love this. I geek out with stuff like this. Okay. Let me share the screen. This is something called the Economic Data Calendar. So basically every week, and these can really trigger and determine the volatility of stocks, the market, and I know I'm talking a lot about stocks. Somebody thinking like, I don't have money for stocks. Is the stock market an accurate representation of the economy and how stable the economy is? Absolutely not, because there's no way that you can tell me that the stock market is consistently going up while unemployment is going up. There should be a correlation. It's just not right. It's not fair. But what I can tell you is that consistently over time, your money will grow in the stock market. You might have some bad years. Look at on the side, Joseph A. Bank shirts. You can tell where I shop. It's a safe way to make money, and it's just been proven over the years. Oh, there's a slide that talks about that. Let's see if I can find it. So this is like for this past week. These were the economic reports that came out in the kind of the calendar. So here's top and see period, actual. Don't worry about the median forecast is not that important, and then previous. So none of these are really that important. Retail sales. Actually, let's go to retail sales. So on the 17th, I don't know if this is a weekly report or let's see if it comes out again. No, it comes out every couple weeks, I think, or once a month. So say you have your retail sales. So what this shows you is that talking to economists, actually here at Chapman, we do a lot of forecasting, and they will send out, their big things that they send out are these little cards to purchasing managers for companies. And they'll ask them, how's it going? How's your company doing? And based on that information, you can kind of project economic results for the economy. So here for retail sales, I'm going to say the previous quarter or previous reporting period, I should say, there was a 1.6% growth, right? What did they project for? What was the forecast for this next piece of information that was going to come out was going to be 0.3, and that's what it ended up being. So they're spot on with that. This retail sales includes automobiles. Retail sales excluding automobiles, they were anticipating, or the previous reporting period, it went up 1.2%. They were forecasting it to go up only 0.3%, and it only went up 0.2%. Not that big of a deal, right? Where's some other this is going to capacity utilization. This means companies, for the most part, manufacturers and it's a lot of factories. Capacity utilization. What are they at capacity as far as their capacity utilization in their manufacturing processes or processes, as somebody I work with says? 72%. That means they're at 72% of capacity. Okay, which is not great. It's okay. They projected it would be at 72.3%. It ended up coming a little bit higher, which means that that manufacturers are producing things or manufacturing a little bit higher than what they projected. Housing starts is always a good one. The previous means how many housing starts or construction starts they have in the country. Previous period is 1.459 million. They projected to be 1.49 million, slightly higher, in it being 1.53, which is pretty good. Building permits, like how many building permits are being pulled throughout the U.S. Previous period 1.54. They anticipated 1.57. It was a little bit lower. So jobless claims, this is a big one. How many jobless claims were made? 711,000 since the last reporting. They're anticipating to be 710,000. It was 742, that's not good. But you can find these. It's called the Economic Data Calendar, and this is available for anybody to look at. It's really fascinating stuff, and sometimes you can kind of use this. And sometimes if you're watching on the news in the morning, they'll have like somebody talking to the stock exchange. Behind them, they got like all these screens and numbers and all that kind of stuff. They'll say oh, the economic data report's coming in and the jobless claims and our new home sales, that kind of stuff. That's where all this stuff comes from. These type of this type of information. So stop sharing for a second. Close that out. Let me see. This is just a quick little video how stocks work. If it's going to load.
And smarter than ever before. Join the community of over 130,000 investors who have built a better portfolio with Fundrise today.
Skip ads. We don't want to.
Hello and welcome to Beginning Stock Trader. Today we will learn about what makes the price of a stock move up or down. To understand what makes stocks and shares prices move, you must first understand a few things about the current pricing of a stock. At any given time during regular trading hours, a stock has three values associated with it: a bid, an ask, and a current price. The bid is the highest amount someone is currently willing to pay for a share of stock, while the ask is the lowest amount someone is currently willing to accept for a share of stock. Each number will usually be shown next to the number of shares the investor is offering or asking for. The price of a stock at any given time is simply the last price a share of stock sold for. Usually the bid and the ask are relatively close to the current share price. The difference between the bid and the ask is called the spread, and it is usually healthier for a stock to have a smaller spread. Now we will talk about what makes the price of stock change. If you have ever taken a beginner's economics course, you probably remember learning about supply and demand. The concept is simple. If there is a larger supply of a product than there is demand, the price will likely drop. If there is a greater demand and not enough supply to match, then the price will probably rise. This is also true with stocks and shares. As was explained in Lesson 1, the stock market is a literal market where a product, namely ownership of a company, is bought and sold. This means it runs on similar economic principles. If there are a lot of investors trying to sell a stock and a much smaller number of investors looking to buy that same stock, the price of the stock will begin dropping. Let's look closer at the reasoning behind the price drop by creating a mini market with 5 people: John, Jessica, Jeremy, Janet, and Jimmy. We will pretend that all 5 of these investors own 100 shares of stock in Company A. One day they find out that Company A messed up on a new product and it will be delayed for a year. 4 of them decide to sell their shares in the company and put them up for sale. Unfortunately, due to the news, there is only one investor that is interested in buying the stock for its current price. John sells his shares, but that leaves Jessica, Jeremy, and Janet all with shares they would like to sell. There is nobody willing to buy at the current price, but one investor has offered to buy at a price $1 lower than the current price. Jessica sells to the investor, and the current stock price adjusts to show a current worth that is $1 less than before. If Jeremy and Janet decide to sell as well, they may push the current price even lower as they seek to find investors to purchase their shares of stock. Sometimes when a company announces extremely bad news, you can see the worth of a single share of stock drop more than 50% in a single day. To learn more about the stock market and how to make money with stock, try one of our stock market courses. You can learn from and interact with professional traders.
All righty. That's good stuff. Let me see. Well, that's it. I got everything I wanted to accomplish in this video. So next video, we'll talk a little bit about mutual funds and ETFs. And that's that. Hope you guys enjoyed this. Hopefully I made sense. And putting some quizzes up and all that kind of stuff. Good stuff. Haven't graded the exams yet. Well, this is actually, I'm sure by this time I have done it. I'm just recording kind of things ahead of time. And that's it. You guys know how to get in touch with me. jdusserre@citruscollege.edu or Dusserre, Dussere @chapman.edu. Our phone number is 714-624-4451. I'm going to have a good weekend. As I record this, the Rams are playing on Monday night. We're having a little, I think we beat Seattle. Feeling good about things. I think we'll beat Tampa Bay. I think we'll get to Tom Brady. And I say we because I've been a fan of this team for over 40 years. Some of the guys on the team could even care less before the season started about the team. So I have more of a right to say we than even some of the guys on the team. So even though I'm not out there playing, but I have more invested than some of these guys. Anyway, yeah, that's it. Talk to you guys soon. Scram.